We're going to start, everybody. Welcome and hello. Thank you for joining us on our webinar today, hosted by the Jacobs-Levy Equity Management Center for Quantitative Financial Research at Wharton. I'm Chris Geczy, one of the academic directors of the center, along with Craig McKinley. Today's webinar is titled Getting to the Core, Inflation Risks Within and Across Asset Classes, and we'll focus on the working paper of the same name. It's co-authored with my colleague Nikolai Roussanov of the Wharton School, who's joining us today live but from overseas, along with Xiangfeng and Yang Liu. We also have Michael Weber from Chicago with us to discuss the paper. Nick and Michael, welcome and thank you. Before we move into the discussion, a few words about the Jacobs-Levy Center. I'd like to take the opportunity to thank both Bruce Jacobs and Ken Levy, whose gifts to Wharton starting in 2011 and whose ongoing partnership and leadership not only established the Jacobs-Levy Equity Management Center for Quantitative Financial Research and the Wharton Jacobs-Levy Prize for Quantitative Financial Innovation, but have helped our center grow and thrive. The gift has been made to commemorate the 25th anniversary of their firm, Jacobs-Levy Equity Management, which they co-founded in 1986. Since then, as many of you know, Bruce and Ken have played a major role in bringing quant investing to the forefront, publishing a series of significant articles in leading professional journals, co-authoring well-regarded books and articles, and generously supporting scholarship in finance, broadly construed. Bruce and Ken's gifts to Wharton have helped ensure the school continues to be a leader in research and scholarship in the field of quant finance. And the center awards doctoral fellowships, supports faculty via research grants, supporting both faculty and, in fact, students. We also maintain a working paper series, of which today's paper is a part, which is available on our own SSRN feed, in addition to the center's website. So if you're not signed up for our SSRN feed, I think you're letting an in-the-money option be outside your portfolio. Included in the series is today's paper, which explores the question of whether, quote unquote, real assets protect against inflation. I know the topic of inflation in general has been at the forefront of many of our minds, and this research by Nick and his co-authors sheds new light on the hedging options that have been traditionally considered safe havens. The paper reviews returns from 1963 to 2019 from multiple major asset classes, decomposing inflation into core and non-core components to weigh the risks on these different asset classes. They find that while asset classes traditionally favored to hedge against inflation, like real estate investment trusts or equity mutual funds protect against energy inflation, they don't necessarily offer protection against core, both of which have been on the minds of both academics and practitioners alike. I'll shortly hand off to Nick to share more details on the research, the analysis, and the findings, but first let me add a bit more on our two speakers. Nick Roussanov, as many of you know, is the Moisa Safra Professor of Finance, academic advisor for the MBA major in quant finance, and academic director of the Wharton on the Market series at Wharton. He's also a research associate at the NBER, and his research focuses on areas of interaction between asset pricing and macro, ranging from equity to fixed income, currency and currency carry trades, and commodity markets, all the way to entrepreneurship and consumer financial behavior. His work has appeared in the leading economic and financial journals of our profession, and he currently serves on the board of directors of the Macro Finance Society, as well as the editorial boards of the JF and the JME. Michael Weber, whom we welcome to the center, is an associate professor of finance at Chicago Booth. He's also a faculty fellow at the NBER, a research affiliate of the Center for Economic Policy Research, or CEPR, and an academic consultant for several central banks, including the ECB, the Federal Reserve Bank of Cleveland, and the Bank of Finland. His research includes asset pricing, macroeconomics, international finance, and household finance, and he's published in leading general interest, economics, and finance journals, is currently ranked at #1 on the REPEC list of top young economists. We'll have a Q&A period after the discussion, so if you have a question, I encourage you to submit it via the chat at any point. Please note in the chat whether you're comfortable being called on to ask your questions aloud. We'd like to do that when possible, not only to give you the agency of having a voice in our discussion, but making the session a little bit more interactive. The default will be that if you send me a question not broadly to the entire group of attendees. I'll consider it to be a private message that you'd like us to ask anonymously. And if you send it to the overall group, then I'll go ahead and call on you. So without further ado, Nick, the virtual floor is yours.
Well, thank you very much, Chris. It's always a pleasure to be here and present to this great crowd. Let me just quickly share my slides and we can get going. So let's see my full screen. You all see me. So as Chris mentioned, this paper, Getting to the Core, Inflation Risks Within and Across Asset Classes, is co-authored with two illustrious Wharton graduates, Zhang Fang and Yang Liu, who are now at the University of Hong Kong. And as Chris said, inflation is now in everybody's mind, but we started working on this paper. People worried about inflation being too low, and we certainly didn't anticipate it becoming such a high inflation becoming such a hot button issue so quickly within the sort of the lifespan of our working paper. I guess it tells you something about how quickly or slowly academic papers get written. So anyway, even though Chris kind of previewed the punchline of my talk a bit, let's jump in. So as he said, we want to understand what assets can serve as hedges against inflation, and what is the cost of that kind of inflation hedging or protection against inflation, or in other words, in sort of more asset pricing terms, what is the price of inflation risk and that is embedded in asset prices. Now, the conventional wisdom that I think is popular among many practitioners, although a bit more perhaps debated among academics, is that so-called real assets, such as currencies, commodity futures, maybe real estate, are quote-unquote real assets. So they're supposed to appreciate in nominal terms with inflation, because fundamentally they're claims to sort of real, either real cash flows or real physical goods and objects, or in other ways are kind of inflation neutral, and therefore provide, if not for protection insurance, they're kind of relatively inflation neutral. And by holding those assets, whatever capital that is invested in those assets ends up being unaffected by inflation. In contrast, of course, to owning nominally denominated fixed income type assets like bonds, government bonds, and corporate bonds that are not indexed to inflation. Now, stocks are often also thought of as real assets because the argument goes they're claims to corporate cash flows, and those cash flows should rise with nominal cash flows should rise with inflation. So it's the real component of those cash flows that matters. And so stocks should be relatively immune to inflation risks. Now, if you look, and all of you here probably have looked at what's been happening in the financial markets in the last 12 months or 6 months, or even today and yesterday, probably have a sense that inflation is not a non-issue for stocks, and stocks might indeed suffer when inflation is high. And yet, as academics, we have not reached kind of, I would say, agreement onto whether that's the case and why. Empirically, the beta of stocks on inflation has been sometimes positive, sometimes negative, and not always statistically significant. And as a result, the price of inflation risk embedded in stocks seem to be kind of ambiguous. So neither are stocks necessarily a good hedge against inflation, nor is it clear how much you would pay for such a hedge if you were looking at equity markets in particular. Now, of course, there has been evidence of going all the way back to Fama and Bill Schwartz in the late 70s, early 80s, that high inflation does seem to be bad news for stocks. But of course, since then, I think some of that evidence has been somewhat discounted because it was heavily influenced by the the decade of the great inflation of the 1970s and the preceding decades, where it's not so kind of surprising maybe that those years of high inflation were bad for stocks for a variety of reasons. But since then, inflation has been conquered, since the days of Paul Volcker, perhaps. And maybe since then, we don't worry so much about inflation, and stocks are no longer as affected by high inflation. Even though, again, as I said, evidence even since then on these real asset properties, those properties of stocks, has been mixed. It's certainly not been kind of ruled out as a conventional wisdom that you can model stocks as being relatively inflation neutral. So, well, we are going to, of course, revisit this conventional wisdom in our paper, as Chris already mentioned, and we are going to revisit it by focusing on a particular way of looking at inflation and measuring inflation, and in particular, the question is, well, what is the component of inflation that investors should really care about? And we argue that this is the so-called core inflation, or in sort of the official parlance, inflation excluding food and energy. What I'm showing here is what you can get from Fred, is the items that the Federal Reserve cares about, the personal consumption expenditure, in a way of measuring inflation. CPI is the one we're going to focus in much of our work because it's more conventionally being accepted both in academia and industry, even though the Fed looks at the PCE, but our results are really don't change whether you look at CPI or PCE. But in this measure in particular shows you that the headline, so-called headline number, the blue one that includes all of the consumption expenditure items, and the red line, this core measure that excludes food and energy, they share the same kind of fundamentally the same trends. Is just one is much smoother than the other. The red line doesn't have as many bumps. It doesn't necessarily get as high in the days of high inflation. In particular, now it's running higher than the core, but fundamentally they move in the same direction. And why is it that the Fed focuses in particular on this red number? Well, the idea is that it's more likely to represent the persistent component of inflation, which is the one that investors should really care about, and consumers also, because the persistent part is what matters for consumer and investor expectations of the future. And in fact, all the talk over the last 6 months or prior to that about inflation being transitory really was driving at that point that, well, as long as this is kind of a temporary bump that is going to fade out, we don't need to worry about it so much. Of course, since then, the Fed's talk has changed quite a bit, as we have seen recently, in large part, in fact, because the core number had been catching up with the blue number. And in fact, of the reading today, we saw the headline number has been slightly slowing down since previous month, but the core number actually is staying as high as it was, if not higher. Again, giving some worry to the Federal Reserve and to investors. So if we look at the CPI inflation, not PCE, again, we're going to focus on CPI. That's what I'm going to focus on in my talk. Numbers don't really matter much. And we decompose the headline number into these three components: core, food, and energy. We see the striking fact that even though energy is less than 10% of the basket, and therefore it's less than 10% of the kind of headline number, its volatility is huge compared to the volatility of the core. And that's what makes it so important for driving the volatility of the headline number, those big swings in the blue line away from the red line that I just showed. At the same time, there's basically no persistence in energy. It's very quickly mean reverting, whereas core is very persistent. And you can see food is kind of in between the two. It's sort of halfway on persistence, and it's not nearly as volatile as energy, but more volatile than core. So in our analysis, we're going to focus on innovations or news to volatility, and we're going to do that by estimating a VAR, vector autoregression, that includes headline inflation and its components and important financial objects that should capture investor expectations about future inflation, like the price dividend ratio of the stock market and risk-free rate, and the output gap, which is kind of common in macro literature. And what I'm plotting here are the shocks that we extract from this VAR. So basically the shocks to the realized inflation, kind of above and beyond what was expected at the beginning of the period, beginning of the quarter. And what I think is striking about this graph, it tells you that at different periods of time, different components of inflation play a different role or dominate depending on what is going on in the economy. For example, energy was much more volatile in the kind of second half of our sample than it was prior to that. And if we look at the shocks to headline inflation, they're almost all coming, at least in that sort of in the eyeball sort of detectable magnitude, they're almost all coming from energy. And that's because core inflation has been incredibly smooth in the last 2 decades. And given that this very low volatility, of course, the bulk of the volatility has been coming from the headline inflation. At the same time, in the prior kind of half of the sample, especially if you look at 1970s and 1980s, even though we have all this talk of the oil shock being an important driver of inflation around 1974, you see that almost all of that volatility is actually also in the core. Yes, there were big swings in food prices in that era as well. And energy, yeah, there is something around 1974. Definitely there's an oil shock spike, but it's by far not the only thing that is, not the most important thing that is going on. Again, the magnitude, of course, is big, but relative to the volatility in other periods, it is not much else going on other than maybe one or two spikes. So in what follows, we're going to focus on these shocks, because shocks, of course, are the kind of the unexpected components of inflation. That's what everybody really worries about, not the stuff that's expected. And we're going to primarily focus on these two components here, core and energy, as well as compare them to the headline. We'll ignore food and for largely kind of simplicity, because its behavior is sort of a kind of a convex combination of core and energy in many ways. But the key is that we're going to look at the sensitivity of stock or asset prices or asset returns to these two different types of shocks individually. Now, before I get to sort of the bulk of our analysis, let me do this maybe a little preview. Kind of how should we think of the takeaways of this look at asset returns as hedges potentially against inflation. So here we're splitting all the quarters in our sample into those where core inflation was either below or above 4%. And we're looking at returns in various asset classes over those quarters. And they're roughly not equal, of course, but the samples, but they're not too different in their size. And what we see is that low inflation tends to correspond to, of course, good returns on bonds, not surprisingly, but also foreign currencies, interestingly. But importantly, stock returns, whether it's US or international, are high when inflation is low. Return on real estate investment trusts are high. If you look at growth versus value, they're both kind of do well when inflation is low. So what happens when inflation is high? Well, when inflation is above 4%, the only asset classes that beat actually this sort of 4% inflation let's say, comfortably are commodities. Stocks, for some reason, my line shifted. Of course, given that it should have been here. I don't know what happened, but they're just stocks do not terribly, but not quite. These are nominal returns, so they don't quite catch up with inflation unless you look at value stocks. Interestingly, value stocks do outperform in these quarters, and of course, treasury bonds do terribly. Interestingly, corporates not as much. We might get to talk about why that is, although I doubt I will have time. Interestingly, also, gold in particular is not a great hedge in those situations. Now, of course, when I say inflation is above 4% or below 4%, I am not looking at those shocks that I just showed you in the previous slide, because of course, much of that inflation is expected. When inflation is running high this quarter, you also expect it to be high, especially core inflation, which we know is persistent. We also expect it to be high in the next quarter. So it's particularly instructive to look at what happens when the shocks to inflation are particularly kind of surprisingly high. And this is what I'm going to add to the next graph. The red bars represent returns in the quarters when the core inflation surprises on the upside. And what you see is that is a kind of a strikingly unfortunate picture, but perhaps not too unfamiliar to us from looking at returns over the last few months, is that stocks don't do well at all. In fact, they do worse than bonds, because stocks are more volatile than bonds, and their returns are actually even lower in these states of the world. And even REITs actually underperform the worst. Growth does particularly terribly. Again, we all heard about, I'm not going to name names of specific funds, but some funds that hold a lot of tech stocks have really been not enjoying these few months. In our sample, actually, value does survive a little bit with a positive return, although of course, again, not a particularly high one. It does look like commodities do shine, and gold in particular, actually, in these states of the world, does again shine, I should say, a little bit tongue in cheek. And this is kind of maybe a little bit in line with conventional wisdom, right? We should expect commodities to do well when inflation surprises in the upside. Again, we have seen this happen over the last year or so. Broad indices of commodity futures being generally doing well, outperforming compared to other asset classes. But of course, one thing that this simple graph does not capture is that even though core and energy and food and inflation don't necessarily move in lockstep, a lot of the times when certain inflation does surprise on the upside, it does so in both core and energy. And so the important thing is, of course, to control for the effect of one when looking at the effect of the other, which is what we do in our kind of main asset pricing tests in our paper. So what we're going to look at now, we're going to look at the asset class return betas on the inflation shocks. Whereas if we're going to look at headline, we just basically regressing asset returns on the shocks to headline inflation. But when we look at core and energy, we are putting them on the right-hand side jointly. So these are multivariate betas, so they control for the effect of one on the other. So what are these bars that I'm showing you here? So as I said, the headline is purple. The bar around the red line is the estimate, and the bar gives you the 95% confidence interval. And if you look at stocks, you basically see the kind of what I described in the beginning as an ambiguous result, maybe slightly mildly negative, but not statistically significant. However, when you decompose betas into stock and into core and energy betas, that's where you see very strongly statistically significantly negative beta on core inflation, and pretty positive, maybe marginally statistically significantly positive beta on energy inflation. And this is why we see this ambiguous picture when we look at headline, because even though the persistent piece, the core, is very strongly negatively affecting stocks in the entirety of our sample, even though, of course, yes, it gets less strongly statistically significant in the last couple of decades when core inflation is not very volatile, its magnitude is basically the same throughout the sample. But when combined with this very strongly positive beta of energy, which is the more volatile component, we end up having this very mixed picture for headline. Now, for bonds, we're not surprised to see that bonds load negatively on all three inflation measures. So we look separately at treasury bonds, agency bonds, and corporate bonds. There's a broad index here, but we also look at some specific portfolios. The interesting thing is that, well, energy, you get sort of a bit of a mixed picture. Energy inflation is a bit more pro-cyclical, and so it has a positive effect on the credit risk and reduces the credit risk, especially of the low grade firms. And so there's a little bit of a mitigating their effect, which is why, in part, maybe corporate bonds do less bad when inflation is high. There is also a bit of a potentially the relaxation of the leverage constraints, since the obligations are mostly nominal, not adjusted with inflation. So for highly levered firms, they get a bit of a reprieve when inflation is high, also lowering credit risk. So what about these so-called real assets, currencies, commodities, REITs, and so on? Well, currencies, even though they look like they have a positive as a kind of all basically broad basket of currencies vis-a-vis the US dollar, they look like they have a positive headline data on the headline inflation. When you split them into core and energy, core is negative, although maybe not statistically significantly so, but basically doesn't give you any hedge, nor does it suffer from inflation, perhaps. All of the hedging properties are coming from energy. When you look at commodities, this becomes even more striking. Commodities look like great hedges. I showed you in the previous graph, they do great when inflation is high, but all of that is coming from their loading on energy, as well as potentially food. The beta on core inflation of commodity prices, commodity futures returns, I should say, 0. Right? Yeah, there are confidence intervals around it, but it's like smack in the middle. What about real estate? Well, we don't have good measures of real estate, owner-occupied real estate returns, since we need to have the dividends as well as the prices to kind of the service flow. But what about investable real estate investment trusts? Turns out they don't protect against inflation at all. If we look at, again, at core, they do as poorly or worse as stocks. Also, I showed in the previous graph. And that is because REITs ultimately are claims to cash flows that come from real estate. And those cash flows, even if there's a more kind of equity-like cash flows, they're not reset. The leases are not reset very frequently. So when inflation spikes, the cash flows don't quickly catch up in real terms. And to the extent that high inflation could be contractionary, that can actually hurt those cash flows in real terms as well. Again, energy being very pro-cyclical actually does show a positive loading for REITs. International stocks don't behave too differently from US stocks. So this is, if you're going to take away anything from this talk, I would say whatever I said in the last couple of slides kind of tells you the main thing is that it's very hard to find an asset class at asset class level, something that protects you against core inflation, against high core inflation. Seems like everything either gets hurt by it or is at best you get a zero beta. Now, to be a hedge, you have to have a beta of 1 or more. And you can only hedge against energy inflation, it looks like, but not against the core, which is the component that you should really worry about, again, because that's the bulk of the basket, and it's the much more persistent part, which of course, again, both investors and policymakers care about. Now, what about the price of protecting against inflation or hedging against inflation? Well, I just said that you can't really, you can't hedge against inflation. Well, it's not quite true, because we can look at a cross section of returns within each asset class and maybe find a wider spread of betas. And then if we have this wider spread of betas, we can kind of form long-short portfolios that that can mimic the properties of inflation. And the average returns on those portfolios should give us the sense of the premium that investors pay for inflation hedging. Well, it turns out that if you estimate the betas in the previous graph and try to align them with the average returns on these portfolios, you get a very striking result. If you were to plot average returns against headline betas, you were just going to get a cloud. But if you do average returns against essentially betas with core as well as betas with energy, as we do kind of in the two-factor kind of cross-sectional regression, you get this very striking, strong positive relationship. So high average return assets like stocks and REITs have actually largely negative betas on core inflation, and also often positive on energy inflation. Assets that have low average returns on average, they either have some of these maybe mild inflation hedging properties, or have zero core betas like currencies and commodities, or just not, they may be hurt and they have high negative correlation with inflation like bonds, but they're not very volatile. So there's not much of a beta risk in them. Interestingly, if you expand a cross section and look at a wider set of assets within each asset class, you see basically the same picture. So this is a fact that holds both within and across asset classes, that high average return assets generally tend to have large negative core inflation betas, and assets that have zero positive core inflation betas tend to have low average returns. I said, well, aren't stocks real assets, right? So we talked about this. Aren't stocks real because they're claims to real cash flows? Why should we sort of not expect stocks to do well when inflation is high? Well, there's this old famous Fama paper that talks about stock inflation and stock returns in real conditions. And Fama's point was that high inflation is a proxy for poor or deteriorating real economic condition. That's why people call it a proxy effect hypothesis. And basically what he showed is that high inflation today predicts low real activity in the subsequent quarter, which again, if you look at 1960s, 1970s, is not surprising. Interestingly, if you look at the entirety of our sample from early 60s up until 2019, so our sample ends right before COVID, so none of the recent events are in there actually, so it's nice out of sample test, I think, of what's going on. You see that this negative leading effect of inflation on real GDP or real consumption growth is still there, although not maybe so significant at quarter frequency, stronger at annual frequency, but it is still there. It's not really there if you look at dividends, corporate dividends, which is what we care about when we're pricing equity, until you look at core inflation. Core inflation is strongly, significantly negatively predicting subsequent corporate dividends, again, suggesting that perhaps the reason stocks react so negatively to inflation, to core inflation in particular, is that because it indicates a deterioration of future cash flows. Even though there's of course this contractionary effect of inflation on output and consumption, which is perhaps even stronger if you look at the headline. Well, question that often arises in the discussion of the effect of inflation on stocks. Well, is it really this cash flow channel, or is it the discount rate channel? That when inflation is high, the Fed is going to raise rates, and that's going to raise the risk-free rates at the various maturities. And also, but perhaps if there is an inflation risk premium, that risk premium will also increase if there is more inflation volatility, for example, or inflation, investors worry more about inflation than they did before. Much of the talk about why growth stocks are tanking has been focused on growth stocks are supposed to be long duration because most of their cash flows are in the far future, and long duration is very susceptible to rate increases, and that's why they're tanking. So we can analyze this by decomposing an unexpected component of returns, again using a famous Campbell-Shiller decomposition in conjunction with VAR, into news that are pertinent to cash flows, dividends, to the extent that they're predictable, and the rest, which is typically attributed to news about discount rates, or whether we think it's risk-free rates or risk premia. It's all kind of buried in there. And what we see is that the effect of core inflation, or core inflation beta, is coming through both cash flow news and discount rate news. We see a negative core beta of the market return, and positive for the cash flow shocks, and positive core beta for the discount rate shocks, which makes sense because obviously positive discount rate shock is bad news. So both of these are telling you that when the core inflation goes up, stock return should be negative, both through the cash flow channel and through the discount rate channel. Now, what about value versus growth? We use 5 book-to-market sorted portfolios. So the first one is growth, the last one is value, obviously the obvious ranking. Well, it looks like for growth, the effect is not actually coming from primarily discount rate news. It actually seems to be primarily coming through cash flow news, whereas value doesn't seem to be much affected through the cash flow news channel, and seems to be much more affected by the discount rate channel, kind of in contrast to what you often hear about the effect of inflation on stock returns. Now, I'm probably, let's see, I should probably speed up a little bit. I know that I don't have forever, and I should give Michael time to talk about his view of our paper. So I will skip the effect of coming through the Fed funds rate. The point is that the effect is coming both through the cash flow channel and the discount rate channel. And briefly talk about the fact that the correlation between stocks and bonds is known to have been changing over time. In particular, it used to be a positive pre roughly 1999, plus minus maybe a year, and then seemed to have turned negative, and which made the 60-40 portfolios very popular and successful in the last 2 decades. And this correlation may have been snapping back to its positive value in the last few weeks again, and remains to be seen. And it's a bit of a puzzle in asset pricing literature why that happened, and there is a range of explanations. We propose maybe a partial but still an explanation of this phenomenon, coming again through this the channel of core inflation and core and energy inflation, in fact. Because if we look at the betas of stocks and treasury bonds on headline inflation, they were both negative pre-2000, but after 2000, stock beta changed its sign from negative to positive, whereas of course treasury bonds remain to be negatively related to inflation. Now, if we look at core and energy separately, what emerges is that switch in the sign of the stock inflation beta is all due to the fact that energy inflation became very pro-cyclical, and therefore very highly correlated with stock returns, generating this very strong positive beta, whereas a core beta has remained quite significant, quite substantially negative, even though, of course, with only 20 years of data, it's not particularly statistically significant. So we argue that the switch in the behavior of energy inflation from the pre-2000s to 2000s, attributable to many factors, but kind of the relative dominance of supply versus demand shocks, has driven this shift in the correlation between inflation and stock returns, and therefore stock returns and treasury bond returns. And to the extent that we're returning to sort of the pre-2000 regime where supply shocks dominate and the variation in energy prices, we might be going back to the times when stock returns and bond returns are more positively correlated, something we have been seeing over the last few weeks. Now, I am probably close to out of time. So I'm going to, I talked a little bit about other real assets that basically currency returns do not provide a great hedge against inflation, especially high interest rate portfolios, carry trade portfolios are very strongly negatively affected by inflation, just as stocks. The US dollar actually appreciates when inflation is high. Again, we've seen that in part. That is the Fed effect, of course, as Fed gears up to raise rates, the US dollar appreciates, but there's also a real rate channel there as well. Commodity futures, by and large, only hedge energy inflation. Maybe there's a little bit of something going on in gold and platinum, but by and large, they don't really hedge against core inflation either, perhaps because high core inflation is contractionary. Bad economic times are not great for commodities either. Again, I'm probably a bit out of time, but you all know my punchline. Separating core and energy really matters for understanding inflation hedging properties of asset returns. And it's very hard to find a good hedge against core inflation, which is the component we should really care about. And now I will unshare and let Michael rebut what I had to say.
Thanks, Nikolai. Michael, over to you.
Okay, perfect. So thanks a lot for having me. It was a great pleasure to read and think about the paper. And so, like, let me just, before I get started, say it straight, if you look at the paper, it's super polished, has many kind of robustness checks and things you wish for if you read the paper. And then at some point, it's clear they already did it. And, it's also, I guess, partially reflecting what Nick said, that they worked on this paper quite extensively. It's also RNI'd, one of the leading finance journals. So that's why I want to, for the discussion today, just put it a little bit in the broader context, in the literature, and then make a couple of suggestions maybe for future follow-up work that I think could be actually interesting to pursue. So as Chris was already alluding to at the beginning, there's somewhat this conventional wisdom. You see it in MBA textbooks, we teach it. You read it in the Wall Street Journal that, stocks, for example, claim to real assets. And so therefore, real stock returns actually should be immune to changes in nominal condition. The question is, of course, is this really the case? And so there has been a little bit of work from cross-country studies, so also just the aggregate market. It's a nice paper by Hanno Lustig and co-authors, where they just actually sort different countries based on lagged inflation. And now let's just focus here on those blue diamonds. So this is the nominal return of stocks sorted in portfolios like high past lagged inflation, low past inflation. Nominal returns are kind of flat, which of course means on the flip side that real returns are strongly negatively correlated with inflation. So it doesn't look like that stock returns are actually providing a good hedge against inflation in an international setting. We've done some work also more in the aggregate market. So in the US, we actually looked at, this is partially reflective of what Nick was alluding to. If you have sticky, coupons, higher inflation means lower real debt burden. So therefore you tend to see lower default risk in the aggregate in the US. And, you might say, well, if firms now are less likely to default, the claim to equity might actually be higher, but actually, no, that's not the case. You also see that higher expected inflation tends to be time actually, when also valuation of US aggregate stock markets tend to be low. And we actually rationalized in a model where we have actually sticky cash flow. So there's not a one-for-one pass through of higher, let's say, in the nominal cost into output prices, at least in the short run, which can actually then rationalize jointly these two phenomena. Now, going back to another point, actually, the Nick and co-authors make in the paper, this is from some very nice work by John Campbell, Adi Sundaram, and Visera, that actually study the, the covariance or correlation between bonds and stocks. And we do see that, for most of the sample, we saw a strong positive correlation between the two that actually then turned negative. And I guess, a big question is it coming back to positive again? And the question, of course, then is, what can potentially explain the changing sign of this covariance between stocks and bonds? And so there's a plethora of explanation. I'll come back to that later on. And, just in terms of do we actually see that there is a systematic price of risk for inflation? And, the answer is maybe there was some evidence in the past, and actually it's a little bit more, ambiguous. There's a nice paper by Marta and Boons and co-authors that actually say that's the reason why actually the small unconditional risk premium for inflation is actually not statistically significant is because the price of risk, consistent with what we see here, is actually the time varying. And the reason for that is, again, consistent with this pharma proxy hypothesis, that the cyclical properties of inflation have changed over time. Inflation used to be pro-cyclical, then became counter-cyclical. And now the question is, are we back in a pro-cyclical regime, which of course then has important implications for the price of risk for inflation. But of course, the key question that Nick is actually answering in this very nice paper is that actually maybe not all inflation is created equally. Maybe we do see, and I think, let me just directly look at the figures. So if we would just focus on headline inflation and betas with respect to overall headline inflation, you would see that actually there's nothing in the data. If you look at, model predicted returns versus actually then average realized returns, it's kind of a flat line, and so there's effectively no systematic loading on headline inflation. And so therefore, that's consistent with what we just said, in the data, it doesn't look like the inflation risk, overall inflation risk, is priced. But then actually Nick and co-authors say, well, actually, the reason for that is because we have to decompose because maybe the cyclical properties, the importance of the different subcomponents has changed. And indeed, they actually show quite impressively that once you actually focus on core inflation, now actually what your simple model predicts lines up nicely with the 45-degree line. So therefore, there's a very tight fit both within, but also across asset classes in terms of loading to overall to core inflation and average realized return. So you can actually make sense of what we see in the data by zooming in on core inflation. And the reason is actually, just tend to see that this is going back to is all inflation created equally? The answer is actually no. So if you compare core inflation in orange versus energy inflation, energy and food inflation, super volatile, quickly mean reverting, very little predictive power for future inflationary pressure, which of course is then the very reason that monetary policy doesn't tend to focus on it. And so now going back to what should we expect in terms of price of risk. This is just from a nice paper by Diego Kensick, who was on the market this year, which just shows if you look now an oil price shock impulse response, oil prices go up, what happens to inflation in the US? There's actually a positive path through to overall inflation. But then if you actually look at, is there a path through into core inflation? The answer is pretty much no. So, often you don't see any path through of temporary, spikes in energy prices into core inflation. And this is by the conventional wisdom of monetary policymakers. This is just from now a decade-old quote by Charlie Evans, the outgoing president of the Chicago Fed. It's we don't see that there's any predictive power of commodity and energy inflation. Therefore, we actually don't focus on it at all, unless there would be evidence that people tend to focus on those very price changes when forming overall inflation expectations. Now, he argues with the co-author that given that the Fed has such a high credibility, there's no reason to believe that this should be the case. Now, at least when it comes to ordinary people, and we've done quite a bit of work on trying to understand how household and firms for inflation expectations, the idea that people have well anchored expectations and that, they would actually have an idea what the Fed is, what the Fed inflation target is, I think it's a little bit far-fetched, which of course might also mean then the credibility is maybe not as high as at least the monetary policymaker would actually wish for. This is from some work we've done in 2018, should be in the JP next month. I would just ask people, what do you think is the average inflation rate the Fed tries to achieve over longer periods of time? 25,000 Americans, you see that about 40% of that sample thought in 2018 that the average inflation target of the Fed is a number larger than 10%. Clearly, not very promising when you actually are a monetary policy maker and try to convince people that actually low and stable inflation is what the Fed will actually deliver. Then actually going back, is it really the case that, households don't focus on oil and grocery-based price changes when forming inflation expectations? Maybe also not really the case. If you ask people, what is your main source of information when forming inflation expectations? Primarily their own shopping trips when going grocery shopping is by far the most important source of information, which then actually also translates kind of pretty strongly into higher overall inflation expectations. So this is from some work we've been doing with Francesco D'Acunto, Ulrike Malmetier, and Fran Ospina. So here we just sorted households based on past realized inflation in the grocery domain, and then elicited their overall inflation expectations for CPI inflation over the next 12 months. If you had high past realized inflation, you have actually substantially higher inflation expectations for CPI inflation relative to households that had very low realized in their own shopping bundle inflation. So again, given that Nick showed us that in the end, grocery, food, and energy is quickly mean reverting, you shouldn't extrapolate from your own shopping bundle inflation to overall inflation, but that's actually what households and actually also firms tend to do. So let me now go back to directly to the paper. So what monetary policymakers then are doing, they focus on core inflation, and then they would say, now actually, if you follow a Taylor rule, let's actually react more than 1-for-1 to any change in core inflation, which of course then means by increasing nominal rates more than 1-for-1, you actually raise real interest rates, which of course would then mean that, to the extent consumer oil equation, kind of as a good approximation of what we see in the data, we should expect lower future consumption growth, which of course, that's just the pharma proxy hypothesis. We should expect that, higher core inflation, tighter monetary policy, lower future consumption growth, stocks are tanking, consistent actually with what we see right now in the data. Now, Nick was skipping over that. So they do this very nice exercise where they run a high frequency event study, kind of trying to understand whether monetary policy shocks, or inflationary shocks result in an updating of Fed funds futures. And then they show indeed that's the case, higher core inflation, higher expected Fed funds rate as implied by Fed funds futures. But conditioning on changes in Fed funds futures, you still do see stocks tanking. Now, of course, and this is totally consistent with the paper and in the model in the paper, we would also potentially expect, and as Nick was alluding to, that there could be potentially a discount rate effect. And so therefore, it could still be the case that ultimately, monetary policy is a key driver of what Nick and co-authors document in the paper. And I think, maybe fleshing this out a bit more in some future work could be very interesting. Given that we discussed in this session, whether all inflation is created equal, I'm also actually just wanted to allude to that maybe not always is inflation created equally bad. And so here, this is from some work from François Goriot, from the Chicago Fed and co-author, going back to our earlier intuition, we said inflation is high, the Fed is actually checking up interest rates. Now, of course, if you're on the zero lower bound period, where actually, in fact, you would want to have negative real interest rates, but you're actually constrained by what you can do, then actually, if you actually are somehow able to check up inflation expectations, you do actually get negative real interest rates. And actually, in those periods, when a CLB is binding, in fact, actually higher inflation could actually indeed be beneficial. Now, we saw that there's this nice evidence that actually there's a flip in or an inconsistency in the loading to overall and energy inflation. Instead, throughout the sample period, we do see that asset classes and within asset class, we have a negative loading on core inflation, which of course then goes back, potentially offering a novel interpretation of this changing stock bond covariance, which of course now I think, going forward as an out of sample test of the proposed explanation, seeing what happens now in the data would be very interesting, because like one prominent alternative explanation has to do with the change in the conduct of monetary policy. You have a more stringent and larger response to inflation, and also a larger extent of monetary policy smoothing. I would argue that we haven't seen a big change besides now a switch to average inflation targeting, but at least not in terms of like a Taylor rule, in terms of the conduct of monetary policy, and that it would actually be a very nice out of sample evidence for the proposed explanation in the paper. And so I think I'm pretty much running out of time. So the only thing I briefly want to maybe encourage Nick and co-authors to do, so here, given that Nick didn't talk about the model, I just want to briefly mention I did a little bit of an exercise where I provide some out of sample evidence directly consistent with the model that indeed, it's a flexible price versus sticky price inflation that really matters for the result through the lens of the model in the paper. And just actually finish and say the shocks in the VAR, ultimately they're reduced form shocks. We don't actually have a structural interpretation of them. In the model instead, the price of risk really depends on whether, for example, energy inflation is demand or supply driven. And so for future work, I think it would be interesting to drill a bit more into it and actually potentially get some idea of, why is it the case that, energy betas flip sign? Is it indeed actually driven by different shocks driving the reduced form innovations in the VAR? And so let me just wrap up here. I really, enjoyed reading and thinking about the paper. And, I don't think that anything I said has any impact on the paper, in the sense that it's mainly thinking about, additional pieces of evidence. And I wanted to provide a little bit of a big picture kind of view, why I think actually the paper makes an important point and pushes the literature forward. Thank you.
Michael, thank you so much. And Nick, thank you. I think what I'd like to ask you to do, Nick, is to respond to Michael's nice comments by way of answering questions from the audience, if you don't mind. So what I'd like to do, and that's in partly in the interest of time, but I thought we'd go first to Ross Shimonenko, who has a couple questions that are sort of right on target. So Ross, over to you.
Yeah, thank you, Nikolai, and Michael, and everyone for this interesting paper and discussion. Yeah, so because we are running out of time, just two quick questions. One, when I think about stocks, they kind of represent the whole economy. So then when we use the right measure of inflation for this analysis, why do we take CPI and not, for example, GDP deflator, which is kind of an overall for economy measure? And second, yeah, so I know that now everyone is worried by high inflation. It's clear why. But if you go back 1-2 years ago, actually everyone was concerned by deflation, what to do with deflation, especially in Europe. And because you said, Nikolai, that you started work on this paper a long time ago, did you go to the stage where you analyzed performance of different asset classes during the deflation times? Thank you.
Yeah, thanks a lot, Ross. So on the first question, it's ultimately, inflation is subjective, right? It depends on the what baskets you're consuming. But fundamentally, if we're looking at asset returns, we should worry about what is the relative and relevant inflation number for the ultimate kind of holder of that asset. And we don't really know what that is, but something that's related to consumption seems natural. So either CPI or PCE inflation, the one that the Fed prefers, personal consumption expenditure deflator, seems to make sense. Now, that said, it doesn't really make too much of a difference. I don't think if we tried GDP deflator, but I don't think it really matters that much which one we use. And now, as far as deflation, well, so most, if not all, of our analysis is linear. So high inflation is bad means low inflation is good, right? So in our kind of in our tests, basically, what looks like deflation is going to look good for most, if not assets, not all assets. The only thing that we want to be careful about, what do we mean by deflation? Because if we look, I showed the graph quickly, but if we look at, again, the PCE deflator that the Fed likes to use, almost all episodes of deflation or near deflation come from, again, energy prices tanking. So during the Great Recession, people talked about deflation. It looked like there was 1 or 2 quarters of deflation. It was all due to energy prices tanking. Yes, core inflation was low, but it never got close, to zero, across zero. So as far as core inflation, it really is not going to show any real deflation. And to the extent that people worry about deflation, our results suggest that it is driven largely by these very pro-cyclical properties of energy. Again, energy tends to tank as a consequence of a big economic shock, like happened in the Great Recession and happened in the COVID crisis in March of 2020. And that's what makes it look, like deflation is bad, at least as far as asset return correlations are concerned. But we have not looked at sort of more fine-tuned nonlinear things that would allow us to detect particular sort of deflationary effects yet.
Thanks, Nick. Why don't we go to Hao, who has a question about tips, but maybe read it more broadly. How would you like to ask the question and tell us where you're coming from? You can think about linkers as well.
So should I wait for the question?
Well, I think you can see it basically. How maybe I'll
okay.
repeat it. I don't even know how.
So obviously, the tips are the most natural hedge. We didn't really, well, we looked at tips in some of our tests just to make sure, but the sample is much shorter than the rest of the data that we use, so it's not in our main body of the paper. But yes, tips are really the only asset class that does provide fairly reliable protection against core inflation. That is true. And you do pay a bit of a price for that. So that as expected.
Did it answer your question?
Yeah, thanks.
Okay, all right, thanks. I should have given you a better warning on that one. And let's go to Stephen, who has a question about temporal decompositions.
Thanks, Nick and Christopher. So just curious, is there like a long run component versus a short run component in inflation, just like the long run risk model regarding consumptions? Does the same phenomenon carry out in inflation? Just curious. Thank you so much.
Right. Yes, potentially. I mean, that's not the way that we estimated, but even in our VAR, you can kind of see that core inflation shocks are very persistent, so they almost act like a long run risk. And then whatever layered on top of it is very transitory. So you can when you look at headline inflation, there's most definitely something that looks like a long run and a short run. There's different ways to estimate it. The very, very simple poor man's version is to show exactly what I showed, which is look at core, and it's going to be kind of the long run component of it, and then everything else is pretty short run. There are obviously more sophisticated ways of doing it. People who in the long run risk literature have done it. Also this paper by Bansal and Zhelyastovic and Ivan Zhelyastovic, our former colleague, there's other papers on that. So yes, the short answer. The long answer, as I said, we're doing it somewhat differently, but it's a very closely related idea.
Pun intended, I guess, right? Your comments are not fractionally integrated. They're concise by comparison. Yes. So Nick and Michael, thank you so much for presenting today. That's all we have time for. Thank you all for attending. Again, Nick and Michael Weber. Folks, if you have questions we didn't get to, I'm sure both Nick and Michael would be appreciative of your feedback. And of course, if you'd like further information on the paper or the center, please visit the website at Jacobs Levy Center, all one word, .wharton.upenn.edu. Again, thanks to our presenters. Thanks for attending. Thanks to Lauren Hurry for arranging the seminars behind the scenes, and we really appreciate your participation. Have a great day. Cheers, everybody.
Thank you.
Cheers.